Okay, so hi everyone, this is Finance Meets Real Estate. We do webinars every Tuesday, 6:30 p.m. Eastern time. We have an amazing guest here today, Anthony Vicino. Do I pronounce your last name correctly, actually?
Yeah, you got it.
Yeah, okay, cool. Yeah, so he's the founding partner at Invictus Capital, and he's an author as well, best-selling author. So he's the author of Passive Investing Made Simple. And so he's gonna get into this topic with us here today. So essentially, from the perspective of passive investor, at least to my understanding, real estate syndication, to basically know what to look out for and how to be confident in selecting a market, analyzing a deal, vetting a potential operator. So Anthony, his company is based in Minneapolis. It has 30 million assets under management. I'm sure those numbers change often, but right. So that provides basically working professionals with the opportunity to invest in multifamily. And he's the host of the Multifamily Investing Made Simple podcast. And like I mentioned, author of Passive Investing Made Simple book on Amazon. So with that, yeah, so we're going to do an open Q&A format today. So if you guys have any questions, feel free to speak up, and I'm going to be relating my questions as well, or you can put your questions in the chat too. And we're a YouTube channel, Finance Meets Real Estate on YouTube. I'm putting it out there. Make sure to subscribe, and this video is going to be on YouTube as well. So yeah, with that, I'm going to pass it on to you, Anthony, and we can have a conversation.
Yeah, absolutely. Sorry, I just got a message I was reading here. So it's good to be here, guys. Thanks for showing up. Just a real quick, I'm super curious. I want to tailor this towards you guys and what's going to bring the most value. So if you guys want to drop in the chat and let me know, what is it that you're hoping to get? If you have any questions, throw it in there around being a passive investor or talking to passive investors. If it comes to raising capital, we've raised over the last 2 years, probably around $15 million of private capital. So we do that quite a bit. But just real quickly from my background, I'll give you guys the 50,000 foot view is that I have really bad ADHD. Growing up, it was very problematic to the point where I was chronically being fired from every job I ever had. And I had some bad jobs that it was it's hard to get fired from those types of jobs where it's I was just doing menial labor, landscaping, and they would just, all I had to do was dig a hole, and I still managed to get fired from doing that. So I knew coming out of college that going corporate wasn't going to work for me. I had to find my own path through life. And that led me to kind of go off and do my own thing for the better part of a decade. I was a professional rock climber, which sounds cooler than it probably is from a it just really means I got to sleep in the dirt a lot and climb on rocks. That's a lot of fun. Appealed to the inner child in me, but it didn't put a lot of money on the table. It didn't do a lot for my financial situation. And there came a point in my life where it was a problem because I tried to marry this woman, and I went to her parents and I was like, "Can I marry your daughter?" And they were like, "How are you going to provide for her?" And I was like, "Oh, that's a really good question." I guess they weren't super impressed by me climbing rocks. And so I left that and started thinking about what I could do with my life that could maybe start putting some money on the table, which at that point, just to give some perspective on how silly my perspective on life was, I was like, who makes a lot of money? And I landed on Stephen King and J.K. Rowling. I was like, they make a lot of money. That's what I'll do. I'll write science fiction and fantasy novels. So that's what I did for the next couple of years is I wrote a dozen science fiction and fantasy novels, and those did pretty well, but they didn't do so well that it could overcome the relational friction that I had with that gal after her parents gave me permission, and she left me. And I suddenly found myself living in the back of a van in downtown Oakland. And I was literally leeching power from the climbing gym, which I was parked in the back of. I would shower in the gym every morning, and I'd just have power cord running to my van, and I would live in that. And I was not in a good place in life. I was $80,000 in debt. Beyonce just left, homeless. And it was then at rock bottom that a buddy came to me and he's like, "Hey, do you want to build a business together?" And I knew nothing. I knew nothing about building businesses at this point. So it was a really ludicrous question. But when you're at rock bottom, it's actually really easy I think to take a leap and do something crazy and that you've never done, step outside your comfort zone, because I don't know, like you're at rock bottom. It's not very comfortable there anyway. I think for a lot of people, the harder part is if their life is like mildly successful, right? Like good is the enemy of great. And if you came out of college and you went into corporate and like you had a good job and you're doing pretty well, but it doesn't fill you with like joy, it doesn't spark your soul with passion, but it's good enough. It puts money on the table and like you get the social accolades, people look up to you. Those kind of positions can be so hard to tear away from. Like the fuzzy handcuffs, like the gold handcuffs, they're so much harder to break than just, you know, being at rock bottom and having nothing to lose. So that was like really fortunate for me, like being in a place where I had nothing, what was I going to lose? So we started building businesses. We started with a window washing company, and we were in San Francisco where there's a lot of windows to wash. We quickly realized like our network of rock climbing buddies they'd be really good at washing windows high up on a rope. So we built this business. And for me, that was the moment where I realized, holy crap, I can be in control of my time, my schedule. I can work where I want, when I want, with who I want through this thing called entrepreneurship. And that just spawned this love affair for the last 15-ish years. No, not 15, maybe 12 years, just building businesses of all sorts of different types. And recently, in 2012 is when I got into real estate. And what attracted me to real estate in particular is just how simple it is. Like it is a very simple, once you understand the very few levers that go into like operating a business, you can do really well. And it's not rocket science. And I started small, like with an FHA loan on a triplex. So I put $7,000 down and bought a building. And then 9 months later, I refinanced that into the next building. And I just rinsed and repeated and kept doing that over and over and over to the point now where we have around $50 million of assets under management with another 30 in the pipeline to be closed before the end of the year. So I'll just kind of pause there. And, you know, that's my convoluted story to how I got here, but I'm still curious, like Stefan, where do you think would be like the most valuable place to take the conversation for everybody?
Oh, I think that's a pretty impressive story there, actually. I mean, if you want to expand a little bit on, because you mentioned like you had like pretty bad ADHD, right? First, and that, and I mean, personally, I struggle with focus, and it's like pretty hard to, you know, that's like the main challenge in entrepreneurship, right? Staying focused on a single task. So how were you able to do that, you know, versus a full-time job where I feel it's like way less volatile to succeed, like, and way less reliant on your perfect focus?
Yeah, I think that's a killer question. That is so let's dive into this. When it comes to focus, for me, there's a really interesting paradox at play. One is when I was young, like I was put on Ritalin when I was 6 years old, and I was on it until I was 16. And I had the adverse effect of, I had a side effect that they didn't realize was a side effect. I just thought it was what the drug was supposed to do. But it made me go into like this really lethargic state where I was just exhausted all the time. And I felt trapped. I physically felt trapped inside my body and my mind. And I would go into what's known as a hyper-focused state, which is, for people with ADHD, it's like the flow state, except for you could go into it around the stupidest things. I could be watching the paint dry. I could go into like the flow state. That's not helpful to move my life forward, right? And when I was given the choice at 16 to go off of Ritalin, I was like, I'm never, hell yeah, I'm going off. I'm never doing that again, because freedom is like my highest value. I wanted to be free. But the problem was I was 16 and I didn't realize that on the one hand, I felt trapped to my biology, but now without the drugs, like I was trapped to like the infinite potential. Like there's so many options in life. There's so many things to get distracted by, so many things you could chase. And I didn't have the systems or the processes in place for me to actually make meaningful progress towards any particular goal. And I did not realize at that point, I wouldn't realize it for the better part of the next decade, that in order for me to unlock that potential, that greatness that I thought I had inside of me, it was going to require discipline. And the thing with discipline is discipline can either come from somebody else, from some external source, or it can come from within. And for me growing up, like I rebuke external authority. Like it just does not work for me. Like you cannot hold me accountable. But the problem was like I wasn't prepared to hold myself accountable either. And so it took a long time to figure out if I wanted to focus, it had to start with discipline and creating environment designs and habits and routines and structure. And within that discipline, then would come freedom. And I think for a lot of people, that's maybe like a counterintuitive thing. But for me, it unlocked a lot, because now once I came up with structures for my day and how to get things done, I could actually get quite a bit done. And so like three things like tactical, because it's one thing to talk about, hey, you need to learn how to focus, but here's three things that can actually help you do this. One, set a timer. Like actually set a timer for when you're doing something. Because as Parkinson's law says, is that the work will expand to fill the time allotted. So if I give something a full quarter to get done, this is my quarterly goal, then it will take exactly 1 quarter to get done. But if I compress that timeline and say, this is only going to take 2 weeks, it's only going to take 2 weeks, because that's all the time that I have to do it. And I find that most people, when they sit down to do a task, they don't sit down and say, this is how long this is going to take me, and then set a timer to hold themselves accountable to it. The second part of this is then time blocking your schedule and actually thinking about like yourself as, I think of myself as current Anthony and future Anthony. And so current Anthony's job is to create the outline and the schedule for what future Anthony's going to do. Like I'm future Anthony's employee, like employer. When I'm sitting down to do my day and like taking all the tasks that I need to do and rank ordering them by like, what's the important stuff to get done, I put it onto the calendar for tomorrow for future Anthony to do. So that future Anthony doesn't get to argue with past Anthony. He just got to show up, set the timer, and do the work. And then the third part of it is that actual last part, which is actually showing up and doing the work and focusing ruthlessly. And what I find a lot of times is that when we sit down and say, I'm going to work on this thing for the next hour, we only end up getting maybe like 15, 20 minutes of meaningful work done on that thing, because every other minute we're like, oh, let me just check my email, or, oh, somebody just texted me, or, oh, what was that thing on Twitter, or infinite number of distractions. And so in a given hour, if you're doing all that and you're paying the cognitive load of like switching between so many different tasks, then you're not getting your best work done. And so what you have to do is you have to hold yourself like ruthlessly accountable to that thing that you're going to do. If you say, I'm going to work for 30 minutes on this thing, and be realistic with this, like nobody can work for 3 hours on one thing without a break, right? So like shrink down your expectations, 20, 30 minutes, and say, this is what I'm focusing on ruthlessly. Nothing is going to get in my way. Nobody's going to come in that door and distract me. Nobody's going to call me. I'm not going to answer my phone. I'm not going to do anything else. Just this thing. And it's so simple, but it's so hard, but it's everything.
Mm-hmm. So those are like great pieces of advice, right? Okay, so set a timer, like how like time blocking schedule and kind of like assigning tasks to your future self, right? And that, but still, like, how did you get to the stage of even, being able to establish discipline for yourself? That's sort of that sort of requires like a focus, if you will, on its own. I mean, focus is kind of physical, right? To your point, if when you were, let's say, on those medications, you were in different states, so they kind of hyper focus you, right? And in that case, right? And so to be hyper focused in a more like non-medicated regular state, how does one achieve this, in a perfect way? Because it's really something that I personally aim to do, and I kind of try to improve it. I typically do get distracted a lot. Mm-hmm. So yeah, it almost seems to me like it needs to be achieved on a physical level.
100%. Yeah. I mean, focus is the result of a biological process. Yeah. Right. And so you need to be really in tune with your biology and recognize that there's three levers that you get to pull that are going to dictate your energy levels throughout the day. And Wallace, I do see your question in the chat. I'm going to get to that. So I just want to let you know. The three levers of energy is going to be your nutrition, your exercise, and your sleep. And those are really the three things that you can do. Like if you get more sleep, better sleep, like you're going to have more energy. If you eat better, you're going to have better energy. If you exercise and move your body, it's counterintuitive, but by expending energy, you create energy as well. And so if you do those three things, you can maximize your energy throughout different periods, but recognize that you are a biological machine that moves in cycles and rhythms. And like I said before, nobody can just sit down and focus for 4 hours straight on one thing. So you have to understand, like, what are the limitations? And the human works, this is maybe getting a little bit into the weeds, but there's this thing called Ultradian Rhythms, which is when you wake up in the morning, your body starts to ramp up over about a 90-minute period. It starts to get into its peak state, and then it starts to come back down. And it does this in 90-minute intervals that are called Ultradian rhythms throughout your entire day. And if you can understand like when you work your best and when you're at that peak of the Ultradian rhythm, you're going to be able to do better work. And so instead of trying to fight your biology and say like, I'm just going to just muscle through this, you need to figure out like, when does your body work the best? And then during those periods of time, get your best work done. And there's a lot of things that you can do with state management to help get yourself into the zone, so to speak, when you need to be there. But it all starts by first understanding your body and what needs to happen for it to be operating at peak efficiency.
And how do you hold yourself accountable though? Like what are there specific things you do to actually enforce that accountability, you know, because it's a different thing when it's externally enforced and when one needs to do it himself or herself.
Yeah, I try to gamify my life as much as possible. So the big driving why in my life is tied back to something that Maslow said. So we're probably familiar with Maslow and his hierarchy of needs, right? But he said something which was that which we can be, we must be. And it was this recognition that inside of us all, we believe that we're great and that nobody thinks that they're average. And so the problem with most people and when we feel discontent and frustration in life is that we're not living in alignment with that greatness that we feel we have inside of us. We feel we have untapped potential. And for me, so much of my life, if I'm not living in alignment with that greatness, then I feel very, very frustrated and discontent. But there's no objective way to measure it, right? I get to make the rules of this game called life. And so that's what I've done is I actually have a spreadsheet on my computer open at any given moment called the rules. And in there's like 15 different things that if I do these things throughout my day, I get points for them. And I gamify it and I say, okay, if I can do all these things, if I can accrue this many points by the end of the day, then that was a good day. And I don't get hung up on like exactly if it's a high score or if I could have done better, because tomorrow is always going to be another opportunity to play the game again. So for me, like I try to gamify this as much as possible. But as Nietzsche, I don't know how to say it. The man with the strong enough why can endure anyhow. So you got to figure out what's your why. For me, it's games. It's trying to be the best version of myself. For you, it might be your family, it might be changing your financial situation. You might be living in the van in the back of a gym right now, and you're like, I don't want this anymore. And it's like, cool. So do something about that. It's much easier, I think, to motivate yourself when your feet are to the fire rather than like when your feet are in the slippers. So as again, like good is the enemy of great. So.
Mm-hmm. That's cool. Do you guys have questions actually? I know Trevor mentioned something on the chat.
Yeah, so Wallace had a question too. He DM'd me. So let me read this out to everybody real quick. He's asking, can we talk about the pros and cons of owning multifamily versus single family? And then how do you pick a profitable multifamily? And then what are some of the tips to max the profit in a multifamily? These are good questions and I like it. So let's unpack this a little bit. So back in college, I actually got my very first start in real estate with fix and flips on single family homes. My best friend, my roommate, and his dad were buying these homes and I would live with them. And in exchange, they would give me a hammer to swing at things. The problem was I can't hit a nail. So I wasn't very good. And I walked away from that experience being like, man, single family, if this is investing, if this is real estate, I am not cut out for this. And so we did 3 of those. And I just remember being miserable. And I think a lot of people, when they think about real estate investing, they think about like fix and flips, HGTV, and turning these like shanties into mansions and being like, what's a slap of paint? And that wasn't me. Like I walked away and I was like, I don't want to do that. When I decided to get back into real estate many, many years later, it was with a bit more research and intention this time to understand like all the different ways that there are to make money within real estate. And the distinction between single family versus multifamily versus industrial and office and retail, right? And multifamily checked 5 boxes for me. It was something that I could control. It was something that cash flowed. It was something that could appreciate, something that had tax benefits, and it had stability. Single families, or not just single families, but properties below like 4 units and under, they don't check all those boxes for me. And the reason why is this. When we talk about control, one is on a multifamily asset, they're valued fundamentally different than a small residential property, right? So a small residential property is going to be valued based off of comparables. So if Ted across the street loses his job during COVID and he can't make his payments anymore on his house and he's forced to sell it at a big discount, well, that's going to negatively affect my house. And I'm like, that's not fair. My house didn't do anything to his house. My house is doing good. It's making money over here. Why is my house worth less? Because he sold his for less. So I don't have control over that. When it comes to multifamily, I do have more control over the valuations because I can go in there and depending on how profitable I make my business, that's going to make my building more valuable. And then that's because it's based off of the income approach, which means how much profit, how much net operating income is left over after every month. So if I go in there and I can increase revenue and decrease expenses, then my net operating income goes up and it's more valuable. And I like that. I liked having that control. And like a single family home, a duplex, a triplex, they can cash flow. This is the second thing I like about multifamily. But the problem is if I have a duplex and one of my tenants moves out, where's all my cash flow go? Unless that one, like the other side of the house, and I bought this thing at like just such a crazy basis, I'm probably just not cash flowing anymore. And I don't like that. I don't like the volatility of one tenant moving out and killing my cash flow. This would be like building a business where you only have 3 customers. If you have a triplex, you have 3 customers. That's a terrifying business. What if one of those customers gets hit by a bus and another one decides to go somewhere else? Like, I don't like that. So multifamily, what's nice is if we go and buy a 50 unit building, I have 50 customers. If one of them leaves, I still have 49. And so that building is still cash flowing, which is nice. From an appreciation standpoint, single family, multifamily, they both appreciate, but going back to the valuation approach, with multifamily, I have more control over how quickly it appreciates by going in there and making improvements that can increase the revenue or decreasing the expenses. From a tax perspective, they both get pretty similar tax treatments. And from a stability standpoint, like I already mentioned with the tenants and losing your customers, multifamily is just inherently more stable. And this is something that we saw in 2007, 2008, the financial crisis, is that multifamily assets, I believe the default rate was still less than 1%. And the reason for that is banks, they lend on these assets based off of less about like your income potential as an earner and more on the product of the building's profit. So what they're looking at in particular is the debt service coverage ratio to make sure that it's making enough money to cover the debt. And if it is, they're like, that's a pretty solid bet. So inherently pretty stable. So those are the things that I like about it. To your other question, how do you pick a profitable multifamily? That's a good question. So the number one thing, location. You can't solve, like if you put the Taj Mahal in a swamp, like nobody's going to want to live there. Like, so it's just not going to work. If you put like the most beautiful building in the middle of the desert, like nobody's going to want to live there. So it all starts with understanding like neighborhood dynamics, and not all markets are created equal. And even within certain great markets, like everybody loves Phoenix, but there are certain neighborhoods in Phoenix you shouldn't touch, right? Like it matters on a hyper local level. So that's the number one thing to look for. What we look for in particular, when it comes to like, is this a good deal? We're looking for things that have the opportunity to go in there and bring up the rent to market. So we're looking for stuff that has some mismatch between in-place rents and market rents. Usually our goal is between $100 and $200 of mismatch. So if we can go in there and buy a building that are currently renting out all the 1 bedrooms at $800 a month, when we know in that market they should be renting at about $950 to $1,000, we're like, okay, that has some upside. That's pretty cool. That's pretty interesting. But we're also looking for assets to say, well, how easy is it to go in there and raise those rents? Are we going to have to like completely gut and renovate this building and spend tens or hundreds of thousands of dollars on CapEx just to realize that gain? Well, I'm kind of lazy. Like, I don't want to do really, really hard, heavy lifting work. We used to do this in the beginning. But in 2020, when suddenly eviction moratoriums made it very difficult to get rid of bad tenants, and supply chains and logistics of like tenants moving in became very complicated, we started making a play towards things where we could realize the gains with less effort. Doesn't mean we just go in there and jack up the prices, but we focus on making improvements to the property that the tenants are really psyched to see, not the invisible things. So what I mean by that is I'm going to share a weird story. So if this makes anybody uncomfortable, just let me know. When I was like maybe 10 years old, I I was a boy. I didn't like the shower. I was like running around in fields and like sweating and playing in the dirt and getting muddy all day. And my dad was like constantly harping me. He's like, you got to go take a shower. You got to go take a shower. Your mom wants to take a shower. I'm like, I don't want to. I don't want to. And this was like a really big point of contention, to the point where he'd like physically throw me in the shower sometimes. And I remember one day, like I went and finally just took a shower, didn't have to be prodded. Nobody asked me to. And I came out and I went to my dad and I was so proud. I was like, Dad, I took a shower. And he looked at me and he goes, son, you don't get any points for taking a shower. You only lose points for not taking a shower. And when it comes to renovating multifamily assets, it's the same thing. There are things that you can do in that building that you will not get any points for. So putting on a new roof, changing out the plumbing, new electrical. These are things that tenants do not care about. They are not going to be willing to pay more rent for it. And thus your NOI is not going to improve. Now, your expenses might improve because you might have more efficiencies. And that might be a very good, compelling argument to go do those things. And we also want to maintain like a standard of living that our residents like and want to stay there, because if they leave us, then churn is no good and we're losing money there. But we want to focus on the improvements that tenants are really excited about. Things like new floors and paint and new appliances, new kitchens, new bathrooms, things when they walk into a unit, they're like, I want to live here. This is awesome. Like typically nobody's going to go to your boiler room, look at your pipes and be like, I want to live here. Those are some good looking pipes. So focus on the improvements that tenants really love to have. I don't know if that answered any of the questions, but
So Anthony, do you want to expand on that a little bit? Because that's like a great point. So to your point, so if you want, let's say if one takes on the strategy of, purchasing relatively, stuff that doesn't require extensive work, right? Sort of to your point, like to your point, being lazy. That's like not like crazy rehab, right?
Mm-hmm.
So you want to buy something and then you want to just kind of focus on, okay, let's improve the business. Let's improve the operating income of the property.
Yep.
So what are like some of the best ways that you have found in your experience for that, so other than, obviously raising rents, but other than, in achieving those rent increases and so forth, or expense improvements. Mm-hmm.
Yep. So the most valuable lesson I've ever learned in any business is that a dollar saved is worth more than a dollar earned. The reason for that is that the dollar earned is always on a margin. So if we're out there, we're operating a really efficient property, every dollar of additional revenue is going to say, let's be on a 50% margin, means I only keep 50 cents of that. So if I can raise rent by $1, well, the amount that's going to make it to my NOI is only 50 cents. However, if I can decrease my expenses by $1, that's a full dollar on the NOI. Okay. And so what that means is that expenses are twice as important in this scenario than raising revenue. And a lot of times when we're focused on like going into these buildings, operators will over fixate on raising rents and trying to increase revenues. And it's because it's sexy. It's like playing offense in basketball. Like we remember who like the number one scorer of all time is. They typically get the MVP award. But we don't typically remember who is like the person who had the most blocks in a game. Like defense is just generally less sexy. So people don't focus on the expenses as much as the raising rents side. And I think that's a mistake, because I think that's where a lot of opportunity is. So the number one expense that you're going to have is churn, is your residents leaving, excluding taxes and insurance and things like that. And you can do things to try and bring those down. But generally, from an operational perspective, churn is the big one. Tenants leaving you and then having to go in there and renovate the units and make them better and then get a new tenant in there. Because during that period of time, let's say it takes you a couple of weeks. Now you've just lost a couple of weeks of income. You also had to deploy some money to go and improve the unit. Whereas if you could keep that tenant, if you could make them happy and make them want to stay there, if you could increase the lifetime value of that one resident, then you're going to cut your churn. And that's a huge concept. And so this means going in there and really thinking about how can we create a community experience for our residents where they're excited to live here. And here's the truth, guys, like we focus on class B and C assets. So workforce housing. When you go to like class A, they have the amenities and they have the concierge service and they get all this like really awesome treatment. Class B, class C tenants, they typically get treated like trash. Like there is an inherent frictious relationship between landlords and residents in this demographic. And it's sad, it's frustrating. But what it means is that there's an opportunity, the barrier to step over and be suddenly overperforming and like over delivering on market expectation is so low that you practically trip over it. As long as you try to get over it, you'll get over it. So what I mean by this is like a little bit goes so far and a lot goes even further. So working with your residents, creating community experiences that make them feel like these landlords aren't just out to, they don't see a dollar. They see me as a person and that this is my home. This is my family. Like that stuff cuts the expenses. And so that's the number one thing. If we're focusing on the revenue side, I think the really big opportunity that people miss these days is really around pets. I think pets are
just if I may hold you for a second on the previous things, it's just how do you actually do this in a Class C building? So let's say the community, like improvements to the community and like so they're happy and kind of reduce the churn rate. But you have a Class C building, workforce housing.
Yep.
What is like an example of something that one can do?
So it can be as simple as putting on events, like live events, and getting the community together for a barbecue and giving them an opportunity to see the property management, the owners, and see other residents. It could be posting newsletters and giving them information about local events and things that are happening in their neighborhood, making them feel connected to that. It could be putting on different drives for like when kids are going back to school and they need supplies and like creating a infrastructure where, hey, here's some backpacks, here's some supplies. Let's get everybody together and like celebrate this in a way where the families in these buildings go, oh, I didn't expect this. And so you can get really creative with it. It's not just about like having really fancy amenities. Like that stuff is nice, but more so it's about like the human connection and making people feel like they're not just living in an apartment building, but that they're living in part of a community.
Got it. And then the revenue side, you started on that one.
Yeah. I would say the lowest hanging fruit, like everybody talks about like pet fees and parking fees and all these things, but like the thing that we see in our market, it's like, it's super interesting to me. It's such low hanging fruit. It's just allowing pets. It's huge to our bottom line, but so many operators in our space, like, I don't know why it is. They're like, oh, we only accept pets up to 20 pounds. The theory being that like bigger animals will destroy the apartment. I don't see it. Then you can get bonds and insurance bonds against this and security deposits, but it's such a recurring, easy source of revenue. And the thing with people with pets is that they have such a hard time finding places that will allow them to have their pets there, that if they move in, they tend to stay longer, which again, cuts down the churn. So, and this one's near and dear to my heart because I have a lot of pets. And I remember when I was like trying to find places to live, I was like, this is impossible. I have a 60-pound dog who's the sweetest thing in the world and nobody will let me live in their apartment. It's crazy.
Mm-hmm. Then what about like, things like rhino insurance, like security deposit insurance and so forth? Have you seen those perhaps raise the capacity to kind of, improve your capacity to have like higher rent even, it's sort of a separate thing, the deposit, but is it perhaps like lowering the moving cost and so forth?
Yeah, I think the rhino deposits are really interesting. We haven't deployed them on our assets, but generally because some of them have like a certain size of portfolio requirement, that if you have like maybe a 2 or 3 unit complex or maybe 20 units and you're just getting started, might not be the best way for you to go. Once you hit a certain scale, it can be really great. We haven't personally done it in our market. I don't know of anybody that does it up here in the Twin Cities, but I know a lot of people down in the Southeast that do. Part of like I coach for Jake and Gino in that community, and I know a lot of those guys and gals have had really good success with it.
Any other kind of like low hanging fruit on the expense side other than churn rate? So what have you found to be like very efficient that works for you?
Well, the big thing for us is that we're vertically integrated. So we have in-house property management, which gives us an unfair advantage, honestly. Now that unfair advantage has cost us a lot of brain damage over the years in terms of like building out property management capacity. But what this effectively means is that we have in-house property managers, leasing agents, repair maintenance teams. So we're the ones that are handling our residents every single day. And this is great for cutting down the expense line item because we are able to, rather than going in and operating these properties and trying to create a profit on the property management side, we just run them at break even, where we're just trying to cover the expense of our heads and like the salary and over all that stuff. But we're trying to leave as much money in the building as possible because then we get the multiplicative effect of the cap rate if we go to refinance it or sell it, right? So every dollar, if it's a 6% cap rate, every dollar that we leave in the building is like worth $15, $16 of downstream valuation. So instead of taking that $1 of profit on the property management, we leave it in the building so we can realize it later with those multiples. So that's a huge advantage. And I would recommend property management is not for everybody. So you have to understand your personality. I talk with a lot of people who are like just starting out, like, should I do this? And my initial thing is yes, start doing it so that you can understand it well enough so that when you do want to outsource it, you can, and you know what to hold them accountable to. So whether or not you want to actually build an infrastructure that allows for property management or not, I think it's really helpful to at least get your feet wet there for a little bit.
And when you said like, okay, so for every dollar of property management, you have like the valuation effect, right? 15, 16x there, depending on your cap rate, right? Mm-hmm. So when you said that, so do you mean just in the sense of sort of, because the same business is the property management kind of in a way, and you not having a property management expense in your cap rate calculation, is that what you mean? Or is it really?
Well, there's always going to be an expense there, right? Like the money's got to come from someplace, and we got people to pay. We got supplies and all that stuff. But what I mean by this is if you're outsourcing to a third-party property management company, they're going to do all the work, but they expect something for the work as well, right? So they want that profit. And so they have like how much it costs to actually deliver the service, but then how much they want to make on top of that. For us, it's just what's the price of our employees and the supplies and whatnot to do the work. Sure, yeah. And so what that means is like the effective expense on like a T12, if you were to look at that, is if you were to outsource it, maybe it's 5 to 8% if you're outsourcing it to third-party management. For us, it's maybe 3 or 4%, right? So what we end up saving is maybe 4 or 5% of delta, which stays inside the property. And for us, like we don't do third-party management for any other companies. And so we only manage our own assets. It's our core focus. We're not trying to monetize that in any way, shape, or form, which is great then for our team, because they know that their only focus, their only job is to deliver an exceptional experience for our residents, which our thesis is if you take care of the residents, that takes care of the building, which takes care of the investors.
Got it. That's great. And so we have a question on the chat from Scott Edwards. So I would like to know the steps to set up a syndication. I'm scaling into larger deals in my real estate development company, but many of the deals I'm analyzing lately are getting out of my reach in terms of capital required, 5 to 10 million total. I have lenders who fund 70% loan to cost on these deals, but when the deals are getting this big, I can't personally come up with the additional 30%. That's why I'm thinking syndication is the way.
Yeah, this is a good question. So when I started, from 2012 through 2019, I was just buying stuff with my own money, and I was doing joint ventures with maybe 1 or 2 other investors, and we were doing just fine there. There came a point though where you run out of money, and if you stay in this game long, like this is the most capital intensive business in the world. Like if you want to just keep doing deals, it's going to require more and more capital. So you got to figure out like. Everybody's got to solve for 2 things. And I know Wallace has had this question he DM'd me on this one. He was asking like, where do you get your deals? The 2 things that we all have to solve for is deal flow and capital flow. And getting those 2 things synced up is the key. If you have too many deals, not enough capital doesn't do you any good. If you have too much capital, no deals, like that also does you no good. So you got to get the right equilibrium there. So what I would say is, if you want to learn how to syndicate, you need to educate yourself. So in 2019, that's when I started actually raising passive investments from people that I didn't even know. Like at this point, we have hundreds of investors in our pool that have been with us for years, and it's awesome. But when you first start, like nobody knows what you're doing, right? Like so you got to figure out how to get in front of them. And I can talk about like how to build a capital raising engine. But first, before you even do that, you need to understand the syndication model, like in and out. Even if you don't intend on being the capital raiser, or you don't want to be the acquisitions or the asset manager, like there's all these different roles within the team. You have to understand it in and out, because listen, like there was a point in my life when I was $80,000 in debt, and I literally had to do the mental jujitsu to determine, should I put my last $10 in gas into my van, which was also my home, or should I buy noodles? Should I buy dinner? And I was living in Oakland, so like ramen noodles cost a lot out there. So for me, $1 is worth a lot. And if I'm going to go to an investor and ask them, hey, you want to put $50,000 into this, and then try to get, 100 of those in so I can say raise $5 million. I need to be really certain I can do right by them. And I think the only way that you can do that is through first educating yourself and then having the experience of like actually having run. It sounds like you have a development company, so you have some experience on that side. I would dive into, there's some books on this topic. There are groups on this topic of like how to actually syndicate. It's probably beyond the purview of this one. But when it comes to actually getting people to give you money, the thing that we found to be the most successful is to lead with education and a genuine desire to help. If you lead with education, and this is why we wrote the book, Passive Investing Made Simple. This is why we have a podcast with over 200 episodes. We put it out there because whether or not you invest with us, like that's not what we care about. We want you to have the knowledge to be able to go in and get into these vehicles, because to us, everybody should own a piece of commercial real estate. Like it's the best investment vehicle out there to us. And so we lead with education and a genuine desire to help. We do not care if people end up investing with us. And what ends up happening is that people, they resonate and they can genuinely see like, hey, we'll hop on a phone call. We'll connect you with other operators that we have no incentive in you investing with them. Like it doesn't do us any good. Like we will go out of our way to do that because like we want you to succeed. And if that's without us, that's awesome. If it's with us, that's awesome too. And so figure out how to lead with education. And it's going to start with your first ring relationships, probably your friends, your family, and just getting excited and talking about this. Like, and this is what's really awkward is a lot of people, when it comes to raising capital, they feel weird because it feels like you're asking people for money. But remember guys, like the two things that you got to solve for is deal flow and capital flow. One is not more important than the other. You have to have both. And if you have the deal, then the capital should be excited to come into that. Right. And if you have the capital and somebody else has the deal, you should be excited to join forces. So it's not about this power dichotomy of you going and asking people for money and coming from this position of desperation. It's saying I have this opportunity. And that's going to start by letting everybody in your circle know what you do. Because the biggest problem that every business has to solve for, whether or not you're in real estate or you're selling widgets, is obscurity. If nobody knows who you are and what you do and how you can help them, then you can't help them. And so you have to find a way, you have to find platforms, if that's having a podcast, putting out content, or just getting on the phone with everybody in your contacts list and saying, hey, I was thinking about you. I've been doing this thing recently. I'm really excited about it. Says, let me tell you about it. And they're going to be like, they're either going to be like, you sound like a crazy person. I haven't talked to you in 7 years. Why are you calling me? In which case you haven't called them in 7 years. So like you haven't really lost anything. Or they're going to be like, hey, it's really cool that you reached out after 7 years. This sounds pretty neat. Like keep me in the loop. Nobody is going to, after that first call, be like, here's $10,000. Like nobody's going to do that. So then it becomes, how do you follow up and how do you stay consistent so that people know that you're serious about this and that you're a professional, not just flying by the seat of your pants? Like, cause that's what a lot of people feel like. They're like, I want to do this $10 million deal over here. And it's like, okay, like, did you just read a book on this and you got like really excited about it? Like, are you going to come back to me with your 9th deal? And most people are like, oh, that's no, I have this deal. It's like, if you're not going to be around for 9 deals, like I'm not going to do one, I'm not going to do this deal with you. And so that's what people are looking for, is like consistency. I don't know if any of that helped, but that's the ramblings of a madman.
Yeah, no, absolutely. And so your book, like Anthony, your book, Passive Investing Made Simple. So what are like some of the things like that you focus on there? Because you mentioned, kind of like, so from the passive investor standpoint, because you spoke to like some of the items also on the, I guess, on the syndicator side or like investment manager side, but what are, let's say, things in terms of vetting a sponsor or analyzing a potential deal? Like what are like some of your, like, I guess like key pieces of advice there for our audience?
So the interesting thing about the book is we wrote it during COVID. COVID hit, deal flow dried up. Nobody wanted to do deals, and we didn't want to do deals either. We're like, sometimes the best thing to do is just to sit on your hands and do nothing. And during COVID, we're like, this seems like a pretty good time to sit on my hands and do nothing. But it's not just about doing nothing. It's about not doing the wrong thing, right? Like, and going and just buying something, not knowing what the macro market is going to do. That might've been the wrong thing for us. So we dedicated our time to creating a resource that would hopefully help some of the people that we're having conversations with, which is a lot of the people that were coming into our funnel at the time were just new to syndications. And what is this vehicle? What is multifamily? Like, I've never even thought about this. Like, most people have never stopped to wonder like who actually owns all the buildings around them. Like, they just kind of assume that somebody rich or some institution owns everything. They don't realize that they might have some part to play in the ownership of these buildings. And so when you're having this conversation with a new investor for the first time, and Scott, this is going to be good advice, is like, as you're reaching out to your friends and your family, you're having these talks, is that it's going to be so foreign to them that the first couple of conversations, it's going to be mostly falling on deaf ears because they're so overwhelmed still. And even when you get really good about talking through the vehicle and how the investment works and all this stuff, it can still take a lot of touch points for somebody to get comfortable. And so that's where the book came from, is like, hey, let's have a resource that people can unpack at their leisure. Because most people, when you're sitting down and having a conversation about investing in finance, they're going to feel stupid if they don't know the answer to a question. And they're going to assume if I ask this, I'm going to look stupid. And so they'll just kind of keep it in. And then they won't feel comfortable actually investing because they never really got the question that they needed answered because they never asked it. And so the book was a way of trying to take all these questions we knew people were trying to answer and put it in a way that was really simple and consumable. And what occurred is a twofold benefit. Is one, this book is really great for passive investors trying to figure out how to actually invest in these things. And I'll talk about like what those three, like the most important parts of that is in just a second. But the unexpected benefit of the book, and I've gotten a lot of feedback on this now, which is pretty cool, is that other operators, people who raise capital and have these conversations with passive investors all the time, like they get a lot of value out of the book too, because it gives them frameworks and metaphors and ways of explaining certain concepts that might not be intuitive. And so if you're looking to raise capital from somebody, this book can be valuable in that it can give you a perspective of like, oh, put myself in the seat of the passive investor and what questions they're likely to ask. And how can I address their concerns when they say, what's the difference between CapEx and cap rate? Like, those are the same thing, right? They both start with cap and they get really confused, like, because everybody gets confused when you try to explain a cap rate. So all that's to say is I'm not pitching the book to sell the books. I'm pitching the book that if anybody here wants a copy of the book, I'm happy to send you a copy for free. So just all you got to do is like hit the like button and the subscribe button on YouTube for this, and then send me an email and say like, I did the thing. I pushed the button. I did that. I subscribed, and I'll send you a physical copy of the book for free. So my email is anthony@invictusmultifamily.com. That's the end of my sales pitch. Which is a really bad sales pitch, by the way. Like, it's a free book. So the three things that we talk about with passive investors is you have to vet an operator, you have to understand the market, and you have to analyze deals. And the mistake that most passive investors will make is that they will jump straight to the deal and they'll start asking about returns. And that's the wrong way to do it, because numbers don't lie, but I can make them say whatever I want. And so if you can't trust me, the creator of the numbers are no good. And so it all starts with the operator. It's betting on the jockey, not the horse. The horse is the deal. But the thing with championship jockeys is they never get on like lame horses. Tom Brady did not leave the Patriots and go to a team that he did not think he could win the Super Bowl with, right? Like, he didn't go. Champions don't want to lose, right? So they're not going to get on lame deals or horses in this instance. So you want to find the rock star operators who have a track record. They have the personality that jives with you. When I say personality, I'm not saying like they're charismatic and they're so articulate. What I mean is they communicate in a way that you resonate with, that they have a thesis that's in alignment with your goals, that they share values. Because like, if you've ever had a conversation with somebody who you're like, man, this person's smart, they really know their stuff, but they make me feel stupid. Like, as I'm sitting here talking to this person, I just feel increasingly stupid and lost and confused. And there's nothing against this person. It just, for whatever reason, I'm feeling dumb. Like, that's probably not the person that you want to work with. In the same way, if you walk away and you're like, I don't have a clue what that person just said. They spent an hour talking. I got nothing out of that. Like, I didn't get my questions answered. I don't have any clarity. Like, that's also probably not good. So like, finding somebody who communicates on the same wavelength. I think track record is so important, but here's the issue, guys. And it is a big issue. I don't know what the solve is that when it comes to private placements, it's a black box. Like I can tell you what my performance is. I can show you the deals. But again, those are numbers that I'm showing you, right? Like you don't have a real objective measure to really see, have I lied to you? Have I really shown you my historical returns? Have I really shown you how that deal went? Or am I just kind of sugar glossing it? And like, you can talk to my other investors, you can talk to my references, but I've probably only given you references that are going to say nice things about me anyway, right? So it's this real black box of information, and it can be scary. It can be overwhelming. And I think the best advice I have for people that are looking to get into this world, the only way to solve for so much information asymmetry is time and collecting your own data points. And so this might be the first time that you ever see me. I would not recommend you reach out to me tomorrow and say, I want to invest in your next deal, because you do not know me beyond this one data point, unless you go and you look back on the last 2 years of podcasts that I put out, or the last 2 years of YouTube videos, or the last 2 years of blogs. And you start to see the hundreds of podcasts that I've been on and how I talk. And you start to collect all these data points and say, is he being consistent? Is what he's saying carrying through time after time after time? If that's the case, you can probably trust that I will continue to operate in that way moving forward. Now, that's a really good reason, if you want to be an operator and raise capital, to start going out there and building in public so that people can see your track record in real time. That's a really great reason. But if you don't want to do that, just recognize that your investors are going to take longer to get comfortable with you. And that's how it should be. So I'll pause there.
So, actually, Scott had another question, like Scott Edwards. So if an investor puts money into a syndication, what type of return should they expect, and how long does their money generally stay in that deal?
I'm sorry, I started reading the notes. And Jay, you don't have to leave a like or a subscribe to my YouTube channel. You can, if you're already subscribed to Steph, is it Stefan or Stefan?
Stefan, yeah, it's good.
Yeah, if you've already subscribed to Stefan, that's totally good enough. Just email me and just say I've already subscribed. I'm not looking to drive people to my platform for that. All right. So if an investor puts money into a syndication, what type of return should they expect, and how long does their money generally stay in a deal? Here's the answer my lawyer always tells me when I ask them a question. It depends. I can never get like a black and white easy answer. It depends. And in this case, it depends too. It depends on the operator, depends on the location, depends on the business plan. There's a lot of different ways that you can syndicate a deal. You could syndicate a new development, right? Like ground up. It's going to take 2 years to break ground, build the building. It's going to take another 5 years after that to stabilize and get it operating and get it cash flowing. It's going to be a fundamentally different deal than if we go and we buy a pre-existing asset that's cash flowing from day one, and we're planning on refinancing in year 2 and selling in year 5 or 10 or whatever, right? So they're going to be different. So what I'm going to talk about here is probably just really high level general return expectations that LPs have. If it's a new development deal, they tend to be viewed as higher risk. And that makes sense because there's a lot that can go wrong before the building ever even gets created, right? So in that instance, investors are going to want a premium on their return expectations. Usually north of 20% IRR is what I see. So if I'm seeing a development deal and I'm not seeing north of 20%, I'm like, I don't know. It feels like I could get something, I could put my money someplace else that has a little bit better hedge against risk, let's say. That's not always the case, but depending on the track record of the developer, the location, it might be a slam dunk. They might only give you 15%. I was working with a developer on a deal here in the Twin Cities just a couple of weeks ago, and he was only presenting 15% IRR to his investors. He's asking, hey, do you guys want to bring your investors into it? And we're like, they're not going to be interested, because on our deals of pre-existing assets that are cash flowing from day one, we underwrite for a minimum of 15% IRR. That's not factoring in a refinance or anything like that. And if we can hit that 15% on a pre-existing asset that's cash flowing from day one, that's a really good deal to us, right? So him expecting that he's going to raise capital from limited partners at 15% IRR on a new development, whereas we're having the same expectation on an asset that's going to kick back cash from day one, most investors are going to choose our deal, right? So he's going to have to bring up what he's willing to give investors as a consequence. Now, if you have a brand new shiny Class A building. And we're not talking about new development now. It's already built. Like, we're just going to go build that. We're going to go buy that building from this guy the day after he builds it and stabilizes it. Well, then my return expectations are going to come down even lower. It might be 10, 12% IRR, right? Because this asset, if it's in an awesome location, it's brand new, has no CapEx needs, like the expenses are going to be super low. It's going to have high occupancy because these residents love it. And it's a kicking area. Like, yeah, like there's not a lot of value to be added there. So it's going to be nice, stable, consistent returns. 10 to 12% IRR might be expected. So those are very vague answers. It's a big range, but that can kind of generally peg your expectations. And just so you know, like on our deals, we underwrite for a minimum 15%, but we aim to deliver 18 to 20%. As a consequence, in the last decade, it's been really, really easy to outperform. And so we look like geniuses because every deal we've ever done full cycle has been north of 23, 24% IRR, but that's less about us and more about the market.
And what about then picking markets, like from the passive investor standpoint? Like,
yeah,
this is the
cool thing about being a passive investor is that you get to pick and choose which markets you want to be in. Like for us, I already mentioned, like we're vertically integrated, which means we're a little bit landlocked in terms of which markets we have exposure to. And particularly, we focus exclusively in our backyard because it gives us a competitive advantage. We know our backyard better than anybody else. If you want to compete in my backyard, you want to take my ball? I don't think so. Like this is my backyard. Now, if I try to take my ball and go down to Nashville, people are going to take my ball. It's going to be very sad. So that's our competitive advantage. For you as a passive investor, though, you get to figure out who are those operators who are badasses in their market and go work with them. And here's the thing that I know for sure about rock stars is that, again, like the whole championship jockey does not get on a lame horse thing. Like championship operators aren't operating in markets that they don't think are going to deliver. You're not going to find them out in the boondocks, like, because they're going to be weeded out. So pretty much if you can find the rock star operator that you want to work with, the chances are high that they're going to be in a market that you're going to find compelling. Now, let's assume we don't look at the operator first. We just want to look at markets. Like we're looking at macroeconomic things like jobs and population growth. Like what's actually driving the people to want to live in a place? These are really important questions. A lot of things that people like to look at these days is like, how much is the rent growth over year? Like Phoenix, I think, is like 20% year over year rent growth. It's crazy. It's crazy. And the question I always have is like these really hot markets, they can seem really great on paper initially, but that growth can only sustain for so long, right? And so I like really stable markets typically, not things that are just kind of like growing explosively, because I don't know, things that explode, they explode. It's scary. So I like steady growth personally, but you get to pick out your own investment thesis as a passive investor and say, I'm going to allocate this amount to this market and this operator doing this business model, and this amount to this other market and this operator doing this business model. And that's one of the coolest things about being an LP. Now, when you're looking at the market research, I would really just focus on, is it growing? Or do people want to live there? And what is the affordability index? I think that's a really overlooked one. So for instance, I can only speak about my market in particular, because one of the great things about only working in your own market is it cuts down on how much market research I have to do. So the thing I know about my market is that we have a really high median income, which is around $70,000. And we have a really low cost of living. So what this means is that we have a high affordability index. So there's a lot of disposable income. So in most markets, you would expect the average person to spend around 30% of their income on their housing needs. In the Twin Cities, that number is about 21%. So what that means is, though our rent is growing at a slower clip, maybe 3-4% year over year than say Nashville, right? What I know is that there's a lot of room for absorption, that people's income can absorb this. One of the big concerns I have about really hot markets when things are growing at 20% is, are incomes also increasing at 20%? Because if they're not, there's going to come a moment when the rents can no longer go up because people don't have enough money to do so. So when I'm looking at a market, I'm trying to understand these dynamics.
Makes sense. So We're going a little bit over time. So if you guys have any last questions, actually, that's been really great. And thanks, Anthony, for answering all of us here today. So if do you guys have other questions? Don, you mentioned you read Anthony's book.
Thanks, Don.
Yeah, very good book.
I appreciate that.
Even if someone that does have experience, you're not a beginner, it's still very good information there.
Right. Because Anthony, you mentioned you started out with writing science fiction books, right?
Yep.
Which is pretty cool. How would you say, did that help you to, I mean, I'm sure that helped you to write the book, but did that help you to, I guess, promote it and kind of know how to position a book in the market from a business standpoint?
It did. It definitely did. And I was not expecting the book to do as well as it did. It hit #1. It was on Amazon's #1 chart for months, and it's been sitting in the top 10 since it launched last August. So it's been really cool. But yeah, I think writing all those other books helped a lot in terms of the marketing, understanding that, because a book is a book, a product is a product. Once you understand how to sell a product, that's a lifelong skill. And so if there's any young whippersnappers out there who are like trying to figure out, how do I get into real estate? The big question is always like, real estate's expensive. You got to have a lot of money, or you have to have a way of raising money. But when you're young, nobody's going to give you money because you don't have the track record yet, right? So the real key is that you have to figure out how to create a cash generating machine that you can then pour that cash into assets like real estate. And if you want to create a cash generating machine, my 2 recommendations, either start a business or go take a sales job where you can just go make tons of money and then pour it into real estate.
So cash generating machine outside of real estate, so sort of as an income stream. Like, would you say that could be a regular full-time job, you're saying? Like,
it could be a full-time W-2. Like, I think I didn't do sales when I was young, but I know, having now worked with a lot of investors, it's crazy how many of them come from sales. I'm like, oh wow, you guys are doing pretty good. That's pretty awesome. Good to know. And I think it's a skill that stays with you for life. But the problem, like when you're 22 years old, you're coming out of school and you're like, I see what you do up there. I want to be like that. It's like, well, you can't just jump to this. And so you're going to have to go and get your FHA and like live in that first house and house hack that bad boy. And you may only need to put $7,000 into it like I did. But once you have that asset, it's only going to be cash flowing a couple $100s per month, which isn't going to change your life, right? It's going to take a while for it to appreciate so you can refi into the next thing. And real estate is a long game. It's not get rich quick. It's get rich slowly but surely. And so as you're buying these assets and letting them do their thing, you also need to have a means of like generating income. And so for me, that was building businesses that then I could just pour everything into real estate. But it could also just be, if you're a great W-2 person, like figure out what you're great at and like figure out how to rise through those ranks and figure out what's the minimum amount of money that you need to live off of so you can maximally invest in your future.
Cool. That's great. So yeah, any other question, guys? Just making sure. I think I covered a lot of questions on my side.
Yeah, this was a lot of fun, guys. I appreciate all the questions. Yeah. I know we went all over the place on this one.
No, that was really cool. We touched on the focus. We touched on like so many other topics. Okay. Well, so thanks everyone.
Thanks, Dan. Dan's holding up a copy of the book. He's about to push.
Yeah. Oh yeah. That's
nice.
Awesome.
Nice.
Cool.
I appreciate that.
Awesome. Okay. Thanks everyone, and thanks Anthony for sharing your time here with us today. It was really great.
Thanks, guys.
Have a good night.
All right. See you guys.